in this new series, right, I'll be sharing some videos, and I'll be primarily focusing on the growth companies over here, right? Like how the characteristics of these growth companies, what metrics to look for, and all that, right? So this is the getting rich portion, and of course, after we get into the companies, we need to know what to do while we monitor, right? So it's not buy and hold forever, but it's buy and monitor, right? And some bonus videos, right? But today I want to focus more over here before we get into like which companies. Is Tesla good, right? We want to find out our financial goals. So, for example, Tesla might be a good company, but like for example, Warren Buffett, he does not have Tesla in his portfolio, and from his perspective, it makes sense because Tesla is quite a long-term outlook. You need to be invested for 5, 10, 15 years to see the results, right? It's more long-term growth. For Warren Buffett, he's already like one of the world richest men. He donated his portfolio to 10x, right? He can't even spend the money. So from his perspective, if you are Warren Buffett or if I'm Warren Buffett, which I may not, like I might think like, hey, as Tesla is too risky for me, I might want to invest my portfolio into, I would say, more stable or like perhaps more dividend companies. All right. So the context for today's sharing is some of us might feel like, hey, we do not know exactly what kind of companies we should look at or what kind of returns we should have. And because of that, right, we are always perhaps a bit aimless and we cannot really fine tune into what we are looking for when it comes to investing, right? So today's session is a bit more about getting more clarity, right? So I want to focus on 3 key points, which is where you are, in your investing journey, right? Because to get to where you want to be, right, which is your end goal. So your end goal could be in objective terms, could be a 1 million portfolio, retire at the age of 50, or 2 million, or any amount, right? So that is your end goal. To figure out how much returns or what kind of companies I need to invest, I need to have an end point and a start point. My end point is my retirement, and then my start point is right now. So right now meaning, how much funds I have, what is my age, every month, how much can I top up into my portfolio, right, to compound more every year. All right, so this is a start point, end point. Once we got a start point, end point, right, we can then figure out the in between, which is how to get there, right? So if I know I need to retire in 15 years time with the amount I have right now, what is the minimum percentage of returns I need to invest? Is it 15%, right? Or is it higher? Perhaps I have been a bit more chill in my 20s, right? And now I need to play catch up, right? So I might need to invest in companies that give me higher returns, right? So these are some of the stuff that I want to talk about. So previously, right, in my 5K portfolio templates, I shared that you can, based on your experience level, right, whether how okay you are with volatility. I remember I used the nasi lemak chili example. Some of us, don't like to eat chili, or using a roller coaster example. Some of us don't like the roller coaster, right, based on our natural instinct, right? So there's 3 levels here, and this one I'll just touch on briefly because I covered that previously. All right. So if you are new, just starting out, right, this might be, this might be your attribute, right? And I think it's okay, right? There's no need to feel shame or like, be guilty that, hey, I'm a newbie, right? Everyone was once a newbie, including myself, or including Warren Buffett. But I think what is important is we are aware that we might be new here, and then, there's new stuff that we can learn along the way. All right. So next level up will be perhaps you're more intermediate, right? You have been investing for a while, you have a few years of good results, and you understand that, you are beginning to understand how the market actually works. Like volatility, ups and downs, is just part and parcel of investing, all right? And over time, you're not too bothered by it, right? And so I'm just being a bit very generic here, just, broadly categorizing 3 different categories of beginners, intermediate, and advanced. So advanced, I would say, are investors who have been investing for a while. And these are the investors who, because of the experience, they are able to take opportunities. Like, for example, during the last year, actually, last March, right? During the COVID crash, like, a lot of people, if you can still remember, it was just 1 year ago, right? A lot of people were panicking and then asking, is this time different? So if, like, most investors will know, right? Like, for example, when the market is fearful, it's time to be greedy. So last year, March, right, during the COVID pandemic, it was exactly almost like a be greedy signal because everyone was panicking, right? This was like the golden opportunity to, load up the portfolio. But not everyone did that. Why? Because some of us are not prepared, and theoretically is one thing to, follow SOP. So I can give it SOP. What's SOP? SOP means be fearful when others are greedy, and be greedy when others are fearful. But for you to execute it right, this takes a bit of skill and a bit of experience. And to escalate, be greedy, right? Like what kind of, so be greedy means I know I need to buy, but exactly what kind of companies should we be buying during the pandemic? So during last year, right, I shared, I want to be looking at companies because this COVID might last a while. That was my hunch. I want to look at companies that are not just COVID resilient in terms of their business, but they actually thrive on this COVID pandemic. That means we'll be talking about companies like Zoom, online companies, Amazon, Shopee, so on and so forth. All right, and I shared a bit more on this the last time during the 5K portfolio template. So I don't want to focus too much in terms of breaking this down, but I want to focus on two other categories today. So one will be your time horizon. So this, right, everyone is different, but the good thing is it's quite basic. That means, let's say, depend on your age right now, and you fast forward to, let's say I'm in 30 years old, and I want to retire by 55. That means I have from 30 to 55. That means 25 years. So how many more years to retirement? And this number is important because I know I left 25 years to compound. Compared to someone I'm nearing retirement age. Let's say I am 55 already. Like this should be my retirement age. I should be retiring this year or next year, right? Then I might not want too much ups and downs in my portfolio because I'm no longer working, and I'm fully dependent on my portfolio to give me like dividends, that kind of thing. So it really depends, all right? So knowing your timeline, I think that's important. The next one, right, is your funds. That means how much you have right now. All right, so you have the duration, and then now you're talking about the money now. That means how much money you have right now, how much money you can top up every month or every year, right? Because so your starting capital might be 10K, but you want to be slowly topping out as you work, right? As you work, let's say every month your salary is 3K, you definitely want to be putting aside a small savings into investment, right? So just curious, right? How many of you, right, actually every month, right, you actually, perhaps set aside or you have some kind of plan. Might not be the clearest plan, but you have some kind of plan to set aside some amount to compound and to grow your portfolio. If you have, right, type 1 in the chat box. If you don't have, right, just type 2. No need to be shy. Right, that's great. Most of you are 1, right? I think that's great to hear. Those of you who are 2, then you definitely want to be listening for the next 20 minutes, right? So your timeline, your funds, right? So 3 key variables here, right? Volatility tolerance is the part I covered in the 5K template. You can rewatch the video if you need. It's on YouTube. All right. A number of years retirement. This is quite easy, just one number, and a dollar amount. All right. So you realize, right, these 3 attributes, these 3 variables is quite interchangeable. And important thing is it can be customized, it can be changed. Right? Maybe number of years to retirement, maybe not so much, but dollar amount, starting amount is fixed. What you have now is what you have now. Right? You don't have more, you don't have less. But your yearly contribution, if you realize later on after the next 15 minutes, right, you realize that, hey, perhaps I'm not on track to meeting my financial goals or hitting my retirement goals. All right, perhaps I need to every year I need to contribute a bit more to my investment nest egg. All right, then you know what you need to do lah. So you can start to go out less, order less McDonald's or bubble tea. Right, so this is what you can do to tweak around. Or if you realize that, hey, you are far ahead of the curve, right? You realize, hey, actually you are very well on track. Then perhaps you can, take the foot off the pedal a bit, chill a while more. Like Charlie Munger, he said, right? He was always very thrifty until he hit his the first 100 or 200K, and then after that, then he can, be a bit more relaxed, right, in terms of saving up, right? So after you have the key variables, right, then this is where you can figure out how much returns you actually need. Whether are you on track to hit your portfolio. So let me explain a bit deeper. So example, I just use a generic template. Let's say retirement age is 55 because it's just a figurative number. Some of you want to retire earlier, 45 also can. So you just put your figure. And retirement goals. Some of you might want to retire with a bigger portfolio or smaller portfolio, I don't know. But 1 million is a very nice number. And also 1 million objectively, right, is a good number. So let me explain. So let's say your retirement monthly expenses. Let me ask you right now, or let's say you imagine down the line after you retire, how much do you actually need a month? Just type your very real figure. How much do you actually need a month for yourself, for your family? 3K, 4K, 5K as living expenses. So assuming, you're a bit older and you might not go out every day that much. So your expenses might be a bit more conservative than what you're spending right now. All right. Don't tell me 10K, 20K unless you really bother, right? Just tell me a conservative on that. Every year, every month, you can use it to spend, and then a conservative buffer, right? So some say 4K, 3K, so roughly around there. So I'm just using 4K as a figure. So most of you might have CPF, right? So you should be able getting like about 1K from there, and the remaining shortfall, right? To make up 4K, you will need some cash, 3K. So this 3K is per month. All right, so if you times 12, right, it will be 36K. So I just round up, right? I think for 40K per year is very comfortable. So the goal here, right, is to hit at least a $1 million portfolio as a benchmark. Because 1 million, if I can, put in some bonds or some stable companies, which I'll explain later, should be able to give me 4%. 4% is 40K, right? And I can live off that without diluting the capital, the $1 million capital. So let's say I reach 55, I can live off 40K a year, and maybe after I pass on, after I pass on, the 1 million is still capital is still intact. I can pass to my wife or my kids or whatever, all right? Or I can donate to charity. So once you have these figures, right, you then need to input it, right? So if you have some paper or pen in front of you, that'd be great. You can write down these few figures. Number one, how much money you have right now to invest, right? Some of you might not even know, so you want to work out your finance. And this amount, right, is assuming you already set aside some operating expenses, at least a good 12 to 24 months of operating expenses. So why is that important? Because if you put every dollar and cent you have in your bank account right now, right, to investment, what if 3 months later you need some money? You never know when you might need it for a rainy day, right? And then if you might need to liquidate some of your Tesla shares at a low price, you realize the space you're in is not very healthy, right? So you always want to be setting aside some rainy day fund, we call it, right? So investment fund, how much? And then your yearly contribution, right? Can you top up? Let's say you're working. I assume you are working professional and you try to save, right? Can you top up 3K a year? 3K a year, that breaks up to what, 300 or 200 per month. I think that's quite doable. And your age, so your age will determine how many years you have to compound. Right, and then very simple, you just take this figure and then you input into a compound calculator. Right, just input in the compound calculator, play around with figures. So 1, 2, and 3 is here, and magically, right, it will give you this figure. So this figure is what we want to be looking for right now. Right, is it 15%? Is it 30%? Exactly how much my portfolio year on year should compound at. Right, obviously the more the better, but I want to know what is the minimum. Right, so in this case, it will be 15%. So if I can just, do you guys want me to demo the calculator? Right, maybe just a quick one. So can you guys see the compound calculator? Can make sure you can see the compound interest calculator. So you can use any. I think it's quite generic, but this is the one I use. So you can play around with the figure. Obviously, if you have more starting capital, it'll be easier. Okay, but I just put a very minimum, I think 10K, right? Some of you might have less, I don't know. So if you have less, right? So some of them might not even have 10K. Let's say we have 5K, right? Then we need to work harder. So maybe every month or every year, we contribute a bit more, right? Just to hit the magical 1 million. But 1 million is just figuratively. Maybe for you is 1.2 million, 1.5 million. In Singaporeans always get also, right? People have 1 million, maybe I want to have 2 million, right? So then you need to play around with the figures, how much to hit 2 million. Okay, so you can play around with this figure later on, all right, on your own time to work out this. So the link, right, later I will put, after I upload the video, I will put the link somewhere there. But you can just search compound calculator, it should come out. All right, just, so there's a few. I think I'm using, what am I using? I'm using Nerd Wallet. Yeah, but any of the top few hits is good, right? So just 4 figures only. And so what you want to do is key in the first 3, because this one you are not sure of, right? This one obviously higher better, but I want to know what's my baseline minimum return that I need. So this I will leave it blank. So this is what we are trying to solve, right? The last figure here, this and this and this I kind of know. These 2 are kind of fixed. My initial deposit, what I have now is fixed. After I set aside 2 years of rainy day fund, and then my time horizon, that means if I'm in 30 years right now, I want to retire by 45, and then I got 15 years, so this is 15. Right, and then if I want to retire earlier, then I need to work a bit harder, right? And then every month I might need to contribute more, right? So you just key in all this figure, and then you will have the rate here, all right? Okay, so go back to the Excel spreadsheet. Okay. Right. So where you are, right, is really more in terms of like how much money you have right now, and you're not comparing to anyone, right? Please don't compare yourself to Warren Buffett, right? Compare yourself to where you were 1 year ago. Are you since 1 year ago, are you on track to hit your goals? Right? What has changed? Right? Is it for the better? Is it for the worse? So knowing how much money you have, your timeline, right, to retirement, right, and your experience level, right? So person A could have a lot of money, right? But maybe he just strike 4D, but he might have zero experience in investing compared to person B who might have a smaller portfolio, maybe 30K, but he or she has been investing for a while. He know what companies to find. So the knowledge and the volatility levels might be different also, right? So once you have this, right, then you can work out using the compound calculator how much returns you exactly will need at the very minimum. All right. And of course, the bigger your fund, then the less you will realize, right? The bigger my starting fund, the bigger, the more amount I can top up every month, the less I would say the ROI I will need, right? So using an example over here, right? So after you have these two, right? Okay, so why the returns is important, right? So it's a step-by-step process. Once you have number one, right, you have these few key variables, then you will figure out the percentage over here. Is it 15%? Is it 18%? Or is it 21%? Once you have this, then you will tell you what type of companies might be suitable for you, right? Because if you need just 3% a year, then you might not need to invest in Tesla and go through the roller coaster ride with Elon Musk. Right? You just need just 3%. Maybe you can invest in DBS Bank or something. So it really depends. All right. So right now I want to talk about what type of companies are suitable based on the percentages. So before we proceed to what type of companies are suitable, maybe I'll just give a short, breakdown into the type of companies out there. All right. And this is just a very, very generic and broad categories. All right. And of course, can a company fall into different categories? Definitely. But this is just a very broad classification, right? Categorization. Right, so you have dividend company. So by default, the name is companies that give dividends. So some examples I can think of is like I think DBS Bank, Coca-Cola, Johnson & Johnson, 3M, and some of your local real estate investment trusts. Right, so these are companies that they might not be growing. So this is the capital position, and then this is the dividend rate. All right. So some of these companies might not be growing that much. I think like DBS Bank over the last 10 years didn't really grow, but I think their dividend rate might not be too bad. Right. So it could be a bit more, could be a bit less, right? Really depending. So this is the first category. All right. And then you have some of the stable companies. All right. So none of these names need introduction. All right. Nike, Disney. Most of these names you realize, right? They all made their name in the yester years, right? Way before some of us were even born. Right. It has been there a long time ago, and some of the founders already passed on, right? So these are companies that have grown to maturity already, and right now, it's just maybe growing at a very comfortable, maybe 5, 10, 15%, or sometimes 20% year after year, right? So after that, right, you have I would say, a new breed of companies, which is like higher growth, right? Some of your tech companies. So Amazon, Google, like even these companies, some of them are quite big also, right? Like I think Amazon or, Apple, they are at like 1 trillion or almost 2 trillion market cap, but they are still growing at 20, 30, 40%. Right. So sometimes you don't have to, if you realize, based on what we covered earlier in the first 10 minutes, if you realize you only need 10, 15%, then actually you don't need to invest in Tesla. Like seriously, you know what? You don't need to, especially if you hate the volatility. But if you love Elon Musk and you love the volatility, then it doesn't matter. But if you hate it, right, then don't have to, invest in Tesla or these are hyper growth companies, but it's also hyper volatile. You realize that this kind of growth, normal growth companies like Amazon, Microsoft, actually you will take care of your needs, right? It's growing at 20, 30%, more than enough, right? So dividend stable growth. And then the last group will be like hyper growth companies. So this is the group that I personally have been focusing on over the last 1 or 2 years. So previously I also started, from growth companies because they are easier to find and easier to look at, and they are more stables. But over time, as I gain a bit more experience, a bit more knowledge, and I realized that, and I also like the, like some of the companies, what they are doing. So this is where I start to position my portfolio into, I would say, more like super stocks or like hyper growth companies. Right, so these are companies, you realize their chart might be a bit different. So I'm just putting this just for clarity's sake. So most of these companies, they started out not making profit. Right, and a lot of people judge Tesla and say like, hey, but Tesla is not making profit, right? Or like C Limited is still a loss-making company. So using maybe let me give you an analogy. It's just like I may look at a 6-year-old kid and say, hey, the kid is not making money. It's a liability, right? It's a loss making. But you must understand the kid at 6 years old, right? It's not their job to be making a salary right now. It's their job to be learning, going to school, getting more information, right? So same for these companies. When these companies are in the, like the children phase or the startup phase, it's not their job to make profit, right? It's their job to what? To learn, do more R&D, make better products, right? To get out there first, right? But after that, the profit will come. So let me ask you, a kid, right? Going with like normal Singapore convention, like most kids will want to like perhaps go to university for what? Like go university don't have immediate ROI, correct? Why not just go to work immediately? Then got profit, right? What I mean, like in this case, got salary, but because they do that so that their eventual salary, 3 years down the line for the next 30 years will be higher, right? Same for this company. So this is what these companies are doing. So sometimes you must understand the phrase of like at which stage, are these companies at, right? So these companies, they have not even hit puberty yet, so to speak, right? So you cannot judge them for the wrong reason. Okay, so I digress too much. So so 4 key types of different companies, right? So after you know the companies, right, then you can have a better sensing of based on your percentage return that you need. Let's say it's 15%. Then you kind of know, wow, actually Tesla makes so much return, but actually I don't need it. All right, I can just invest in maybe stable and grow companies and maybe a bit of dividend company. Then enough already, right? So this is where perhaps you can get a bit more clarity. So what are the type of companies that are suitable for you? Right, so moving ahead, right, I will just break down and do a few examples to share a few. Let's say you belong to this category. What kind your portfolio template, right? Your portfolio makeup. How can you have a mix of different companies? Right, you don't need to have all hyper growth, or you don't need to have all stable. Can you have a mix of different companies? Sure, you can. All right. So let's say we start from someone who just graduate university or poly, just join the workforce. Right? So someone who is younger, he or she might not have very large savings, but he or she is young, a bit more energy, willing to learn, all right? And nowadays, people in their 20s, they always like to retire earlier, all right? So let's say if I'm in my 20s, I might want to retire by 35. Right? So this is just a possible archetype, right? So possibly their portfolio might have a bit more growth and hyper growth companies, all right? So their portfolio makeup, right, might be something like that. Okay, so again, this is not a template for you to follow. It's not a Bible, it's just a guide and illustration, right? Just use it to give you some ideas, right? And then you can work out your own portfolio, right? So obviously, if I'm in my 20s and I have the time right? So sometimes I might be willing to stand the volatility, but let's say I'm not interested in investing. And there's nothing wrong because I like to spend my time, hang out with my family. If let's say I've got kids and all that, and we'll talk about in the other archetype. But let's say I'm young, right, just starting out, right, my portfolio might be something like that. And I think 35% is quite comfortable, right, based on the returns here, right, 35% year after year. If I invest in the type of companies that can give me more than 30, 40% returns, all right. And again, using the calculator, right. So let's say my starting fund as a just graduate guy might not be a lot, or could be even zero here, but I'll be starting to make money, right? And if I spend less on property every month or every year, I can contribute to $2,500 per month is what? $200 or lesser? So less than $200 or $150, I think is doable, right? And so let's say I'm 20 years old and I want to retire by 35, right? And compounding at a 35% return, I will get 1.1 million, right? If I don't need to retire by 35, if I can retire by 40, then obviously I will have more, right? So this is where the law of compounding will work in your favor. Okay, but let's say I'm in different archetype, 30 plus. I've been in the workforce for a few years. I'm like a working professional and very busy, working professional. Like don't have time or energy. Like I might have the time. That means after work, I go back home or now work from home. After 5 p.m. I switch off, eat dinner. I might have the time instead of watching Korean drama, I might spend 1 hour investing, but I might not have the mental headspace. That means I'm like so tired already. I just want to chill, relax. So I might have a bit of time, but I don't have the energy or focus to, go and learn investing. Right, that's fine also. All right, so I'm just doing this as an example. So in case there are some of you who belong to this group, who just, a bit busy, don't have the time to learn, it's okay. Then you can take the shortcut. The shortcut is you go ETF, which I mentioned before. But and actually, I never really share that much about ETFs and indexes, like what are some good ETFs out there. Anyone is interested in this topic, I always focus more on like growth companies, right? Like anyone interested in the topic, just type ETFs in the chat box, right? So I know if there's interest, maybe I can do a sharing on this, right? So possibly you can go the lazy way, shortcut way, whatever you call it. But there's no shame in that, right? So I look at myself like the real way, right? I like perhaps, I always, in secondary school, I was always a bit better with numbers because my mom was an accountant. And my dad used to be a stockbroker, right? For those who don't know. So I guess I have a bit of, good genes from them. But let's say in the parallel universe, right? I'm someone who hate maths, hate numbers, hate business. I can still do very well just investing in ETFs. I don't have to be, because my secondary school, my maths was my worst subject, then I cannot retire nicely. I still can, right? So you can go the ETF direction. So if you go the ETF direction, right, the companies that you have, I would say a huge bulk might be ETF, but you can still, so you customize. This one 100% ETF can also, right? But let's say for fun sake, all right, let's just have a bit of growth company. This one you can just buy Tesla and then maybe buy Shopee here and then the rest ETF, right? Then your returns might not be that high because, you took the easy way out, and then you have an average return of 18%, which is quite doable. 18%, right? Let's say you have, because you're 30 plus, I would assume you have 10, 20 or 30K of savings set aside. And every month, because your salary is higher, you might be able to contribute a bit more, 4K annually. 4K annually, 1 month is also about $200-$300 or 300 plus, about there, quite doable, okay? Right, and then let's say you're 30 plus, let's say 35, and you want to retire by 55, then that means 20 years old, all right? Your timeline is 20. Okay, so you want to retire earlier, then, so all these are adjustable. If you want to retire earlier, then drink less bubble tea over here, contribute more, right? So this will, and then 18% annually, right? So this is where you will, so it's still very doable, right? So like, it's not that hard to, visualize. So most of us as human beings, right, we can only visualize linearly, but we cannot visualize the compounding power. Can you see this graph? This is not a linear graph. If this is a linear graph over here, then it might be a bit hard, or it might take donkey years to get to 1 million, right? Because the power of compounding, all right? So it makes it easier. And you realize so you see there's green and blue over here. The blue, right, is your starting fund, and then along the way you top up, all right? But the green, so this is the blue, this is your own money. The green, right, is your profits, your capital gain. So can you see the exponential difference? Yeah. So this is the beauty of compounding, right? So this is 30 plus. So let's say you are in 40 plus, right? So I'm just going, just giving a sample of 20, 30, 40, so on and so forth. And 40 plus, you might be a bit closer to retirement, all right? And also maybe you just at such an old age, some of us might think, wow, I already so old already, I don't learn, 我这样老了，我不想学东西, But let's say I have a bit of savings, right? So a possible portfolio makeup, right, might be to have a bit more stable companies, and also because you are transiting to retirement, I would say, right, have a bit of a dividend component in your portfolio. I think it's not too bad also, right? So your portfolio might look, for a 40 to 50 age group, might look something like that. Don't need hyper growth already, so don't need to invest in Tesla, but still have a bit of growth companies. But the rest the bulk of it is still in stable companies that you and I can understand. Starbucks, Disney, and then some dividend companies, right? And your average return will be much lesser, right? So because the bulk of it will be in, I would say, companies that don't appreciate that much, right? But it's fine, right? So 10%. So 10% growth. So I'm just using maybe 100K or 200K over here as the starting capital, all right? And let's say every year, because if you're 40 plus, and I will assume you might be in more senior management, mid or high-end management, you have a bit more salary or bonuses, you can contribute a bit more, all right? And then you work out the figures, right? So this is just an example. Later on, I will recommend all of you, if you're not familiar with the how compounding works, this calculator, you never ever type in a compound calculator before, later on will be a good time to do so, okay? All right, so again, like everyone knows that law of compounding. So this one, not I say one, this is just paraphrasing Albert Einstein. So some of us might know like a compound interest is very powerful, right? But how many of us are utilizing it to our own benefit, right? So all of us might know compound interest is like the best thing since sliced bread. But how many of us are actually using it in our daily life? Not just for money, not just for like wealth, but also like for health. Right? Are we compounding on health by eating the right foods? All right, how are we compounding our relationships? To build relationship with our family, our friends, and all that. So this is something to think about, the law of compounding. Right. So just again, try to summarize. So it works step by step. Once you have your key variables, that means what type of investor are you? Are you a bit more experienced or totally new, cannot stand volatility on, market job you are panic on, and then how much starting funds you have, how every month, every year, how much you can top up, and also how many years you have to your retirement. Right. So retirement doesn't have to be 55 or 65. It can be the age you want to set up. Can some of you, especially those younger, you want to retire by 30, 35, also can. Right? There's no right or wrong here. But if you want to retire earlier, then you know that you might need to put in a bit more hard work. Right? So knowing these variables will give you the key variable here, which is the percentage return. Right? So what we are trying to do is getting the percentage returns that we need. Right? So this is like the bare minimum. Right? Is it 12%? Is it, if I want to retire by 30, then I don't think maybe 12% cannot. Maybe I need like 30, 40%. Right? So whatever is that figure, right? Once you have that figure, then I will know what kind of companies will give me that percentage return. If I need to compound at 35, 45, 55% return, then maybe DBS Bank is not going to cut it for me. I might need to invest in higher growth companies like Tesla or City Limited or CrowdStrike. Right? So this is where we go through this process in a step-by-step manner. Right? So this is a key summary. So the action steps for you, maybe tonight or tomorrow when you have time, when you're fresh, right? Start designing your own portfolio, right? And so I'm just broadly classifying stocks into these 5 main categories, right? Dividend, stable, growth, hyper growth, and also ETFs. So ETFs, right, is kind of like a hybrid because there's some like hyper growth ETF, right? And there's some like more stable ETFs also. So ETFs, for those who don't know, is exchange traded funds. It's like a basket of different kind of companies that belong to that group. So I could have a dividend stocks ETF, right? So this ETF might have all the dividends companies per se, right? The benefit of ETF is that some of us might be a bit lazy, don't have time to focus on individual stocks. We just buy the whole basket or buy the whole industry. All right. So this way we take the guesswork of the equation. Right? Every year or every month we just dollar cost average, right? And we can dollar cost our average to our million or 2 million portfolio. Right. So you want to design your portfolio makeup based on 4 key variables, roughly. Okay. Your time horizon, your fund size, starting how much you have. This is kind of fixed. Top up every month, every year, you can top up different amount. If you know you're falling a bit behind, then you need to top up a bit more, be more serious in your money top ups. If you know like, hey, I'm in a bit ahead, then okay, like humans are like psychological creatures, right? We can, be a bit more chill in our spending and all that, right? And also, I think third one is very important because like all of us want to invest all of us want to have the highest return, but are we willing to sacrifice for it? So for example, if I want very high return, like I want invest in Tesla, that 10x last year, am I willing to stand the volatility? Am I willing to, oh my God, Elon Musk tweet again yesterday and then market dropped 5%? Is that the willingness you are willing to, are you willing to, stand through the volatility? And are you willing to read out more about these companies, right? So you might have the time to learn, and do you have the energy to learn also? Because after a whole day of work, you might be a bit tired, right? Then if not, then where's the time? So this is something that is a negotiation with yourself, right? If you want a certain standard of living, a certain retirement portfolio, instead of 1 million, you want 2 million, then what is your willingness? What are you willing to put in? Everyone wants to be rich, but not everyone might put in the time, the effort, the focus to learn, right? So, and do you like doing it? Innately, right, I realize students that I teach, like if they don't have the curiosity about business or numbers, you can start to build a passion, right? But if you still hate it, right, like, oh my God, I hate it, but I just need to do this so that I can get rich, damn sucky. Like if the mentality is like that, right, then it might be a bit hard because you are going against the wave, you're going against the current, right? So one way, if you really don't like doing it, then it's fine, man. Life is not all about investing, right? Because like once you solve for money, then it's about maximizing happiness. Like you only live once, do whatever you want to do, right? So if you don't like to do it, then or you think it's too hard and it's the area that you don't want to learn because my time can be spent, everyone got 24 hours, right? I can take the time to learn something else, right? That can bring me more happiness. Then sure, go for it. Then what you can do is invest in ETF. So I think this and this might go hand in hand. Okay, and your volatility tolerance. So everyone who start out might not be that comfortable with volatility. The first time I sit a roller coaster ride, I might vomit after that also because first time. Then after that, I don't want to sit again. But if I tell myself that, hey, I want to get there, I don't want a 1 million portfolio, I want a 10 million portfolio, or I want to aim for Hall of Fame return, I want to be better than Warren Buffett, then I need to keep sitting that roller coaster ride until I'm comfortable with it. So I just go again, 2 times, 3 times, 10 times, 100 times, right? Until I'm used to the markets ups and down. So the most seasoned investors, right, they're actually immune to it and they actually embrace the volatility. Like in the last year March crash, right? They actually crave it. Like this is like some of the crash. Some of my friends describe it as like almost a very, very shock feeling. All right. It's like, yeah. So this is something that you have to work out on your own. Okay. So that's actually the end of my sharing. So the key action steps, right, is really just, so today, right, I just want to keep things short as a short introduction, right, to what I want to be sharing upcoming. So in the next upcoming videos, right, I'll be sharing more on this portion. I think this is the key portion, how to find the growth companies, what to look at, all that, and also some maybe other miscellaneous content. But I thought I want to get this out of the way first, which is, knowing a bit more clarity on yourself before we tackle, what is out there, what companies should we invest in. We want to know these companies, at the end of the day, is it suitable for my portfolio and my, my whatever is going on in my situation right now, right? So this is more of over here, right? And how many of you will be, okay, so my focus, right, is actually more on, I would say, hyper growth companies. But I do understand, right? Depending on your age, your risk appetite, and whatever we just discussed, you might be investing a bit more here, or maybe some growth companies, right? Which I never really touched on also. How many of you would like me to share a bit more? So you see, you realize these are two different type of companies. If it's two different types of companies, you want to use a different metrics or different characteristics to find them, to spot them, right? So for growth companies, like some of your big boys, Visa, Microsoft, how many of you would like me to cover on this also? Right, if you like, just type, let me know your interest in the chat box. Okay, so if you want to take a screenshot or print screen, please go ahead. All right, and then, but I think it's quite straightforward. And then later on, you can go and find the compound calculator and play around with numbers, just so that you know that, if you want to have a 1 million portfolio, exactly how much percentage you need. And if you can't hit it, then, can you change some of the variables to get there? So I'll take a few minutes to do a bit of Q&A. Okay, back to the compound calculator again. So again, these figures, all the numbers are interlinked, all right, in case you didn't realize, right? So for example, this 15%. And let's say every year I contribute, or monthly contribute 300. Let's say start with this amount, all right? And if I want to retire in 20 years, then this will have to go higher. Okay, compounded annually. All right, so if I want more, less years, then I need more returns, right, to hit the same, let's say in this case, it's 1 million. So you want to play around with the figures and see, what is your ideal range, right, for each category, right? So again, don't need to pinpoint a fixed figure. Oh, it must be exactly $300. It could be a range. It could be about $200 to $500, all right? And make sure, and once you know this figure, why is it important? So that over the next 1 year, 2 year, you want to, I don't know, write it out somewhere or print screen and paste on your wall, right? So make sure every month you are contributing this amount to your portfolio. Because if not, then your $1 million nest egg will not happen. So you need to make it happen using this methodology per se. Okay, so hope you guys find this sharing useful. All right, so if you like it, please help me like and subscribe to get more notification on videos. All right, any questions? I'll take the next 5-10 minutes to answer some questions on this topic. All right, so I have a question on in terms of concentration. Someone's asking, hey, let's say if I want like hyper growth companies, do I just have one or two companies? Or, so that is more on your, so there's a different topic altogether. That is more on like how to size in terms of my position sizing. Do I have like just 3 companies or 30 companies? Right, so I will cover that maybe at a different date. So that is more under, I would say, portfolio management, right? Some portfolio rules or guidance for you, depending on your makeup also, right? So that's and there's a lot of different factors, which is why it's hard to, once I start on this topic, it's never ending, right? There's the few factors like, are you more concentrated or do you prefer more diversified portfolio? And that will based on certain factors, and also how big your portfolio. If your portfolio is only 5K, then how many companies you want, right? It doesn't make sense also to have too many companies. Okay. Right, so someone's asking about entry price, exit price. For entry price, exit price is mainly more on, I would say, the margin of safety that you're willing to pay for a certain company, right? So this is more on, a bit more on valuation, which I'll cover a bit more next time. All right. Any question regarding to these maybe financial goals, these specific topics on? And right now, right, I would say a dollar cost averaging strategy will be very good for most of you, especially if you are topping up every month or every year. So let's say every month you top up $500, right? That $500 you can pro rata into your companies. Or if it's like not enough to buy, then maybe every 2 months, 500 plus 500, 1,000, and then you buy whatever companies that you need. So every few months or every quarter, right, you just buy using the same percentage, your allocated tranches, and just buy them regardless of the share price, regardless you think it's high, it's low, but you just buy. So you want to set a fixed date for it. So maybe if you do it every year, then you can just find a date like my birthday or something like that, or January 1st or January 2nd, or Chinese New Year, Chusi or whatever. If you're doing every quarter, then you just do it like maybe the first week of that quarter or something like that. So this take away, why do you need to fix the date? So this take away the guesswork, right? Because if he's very vague, he's just, I need to buy this quarter 3 right now, or we are in quarter 2, all right? But right now prices are a bit high there, so this is where, so the whole idea of dollar cost averaging is it removes away the guesswork, right? And the whole idea is if you just buy, regardless it's a bit high or low, it will just average out, and you will do very nicely over the long term if you invest in the right companies. So using Amazon as an example, let's say over the last maybe 10 years, every quarter you just buy one share at the first week of the quarter. All right. You don't need to, so last 1 year will be from, let's say, 2011. All right. So you can buy, you don't know where's the highest, where's the lowest, but you just buy one share. All right. Do you realize you will do very well? Like, doesn't really matter how much, like you will just keep averaging out. So sometimes, yes, you might pay a bit higher. Sometimes after you buy already, it might drop. But in the long run, it doesn't really matter that much. So Roger is asking, what are some of the hyper growth companies? You can check out my portfolio. I think I do share my portfolio openly. All right. So there are a lot of companies out there also. So for example, using fitness energy. Let's say I want to get a six pack. There's different ways to get a six pack. All right. But I need to find a way that is sustainable and suitable for me. So in terms of selecting companies, I want to find companies that I understand, that I feel strongly about. And that's one of the reasons why, like, some of you are asking me about Palantir, but I'm not really that keen on Palantir simply because, I just, there's a few reservations that I have about Palantir. Maybe next time I'll do a sharing on this, right? So what I'm trying to say here is you want to find companies that is more suitable for you. And some of you might know my top 3, right? Tesla, C Limited, CrowdStrike, all right? So, and my top 2 is Tesla and C. I think these 2 companies will do very well in the future. And again, disclaimer, this is just, I'm just sharing what I personally own, my own skin in the game. All right. I'm not advising you to buy Tesla or C Limited because your financial goals might be very different. Right now, you might be in retirement stage. You don't need to 10x your portfolio, right? So why do you invest in Tesla? Like Warren Buffett don't need to, he's already one of the world richest. He 10x his money for what? Like there's no additional meaning to him. You know what I mean? So it really depends on the stage you are. Right. Someone is asking about insurance-linked policy. That's a bit out of my. By the way, I'm not a licensed financial advisor, so I think not very good for me to say this. But I can share personally. I do not own any investment-linked policy. I feel like my insurance style is more like buy term, invest the rest, because I can invest myself. And most of these investment-linked policies, there's very high, I think high charges. You can check with your. You can there are some like money blogs out there that will share about this. Speak to friends that you trust, or like you have friends who are insurance agents that you trust. I can speak to them. Instead of investment linked policies, right? Find it could be like so you pass the maybe insurance company, like you dollar cost average $100, $200 every month, and they help you to invest in some funds, right? Depending on the fund makeup, right? How much the fund charges every year and all that, right? You will really eat into your returns. Right? So you want to find one that is very low cost, right? That is the most important thing. Right, so Yo is asking, what will I do if my top 3 conviction companies stay stagnant? Stagnant in terms of what? In terms of business or stock price? That's the key difference. Right, so I'm always looking at the business. Right, so I'm not looking like stock price can stay like right now. I think since January until now, it's about 6 months. Most of our companies like kind of went sideways for 6 months, but it's okay because over this last 6 months, do you think the business actually improved? I think definitely, right? So I'm more focused on the quarterly reports. Is there any improvement in the business per se? So for example, let's say I just use Amazon as an example. So Amazon over the last 1 year perhaps is like sideways. So this is exactly, let's say from June last year or July last year to here is about 3,400, right? So this is Amazon. And if I use Amazon business metrics, just some rough numbers, right? So this is 2021 first quarter compared to 1 year ago, right? The business improved, I think, from 75 billion to 108 billion. Right, so you realize the business did not stagnate. The business actually improved, and the numbers looks really good, right? So this is where, as investors, right, you want to have your eye on, are you focusing on the important stuff, right? Like the right metrics, okay? And Roger is asking, if the Fed does tapering in the future, will you suggest to? Okay, so this question, right, is more when you ask about external stuff. That means maybe let me share this chart that I think might be relevant to some of you. So give me a while. I think this is quite important. All right, so bear with me while I open. So I'll be sharing this at a later date, like how to ignore in a video that is more on like what financial news out there are important and what are not so much. They are noises. Okay, so okay, share screen. Yeah, so usually I like to focus on what I can control. And again, credit goes to whoever did this chart. You can take a screenshot if you want. It's not done by me. I just saw it was very nice and I shamelessly just copied it, right? So this is the thing, like I think the best investors sometimes they are very good copycats also, right? You don't have to reinvent the wheel yourself, right? Find out what the other top investors are doing, like Warren Buffett or people that you know around you who are better investors than you. What are some of the habits that they have, and then copy from there, right? It's not school, right? You don't get penalized for copying, but actually you get better results if you copy, right? So focus on what you can control, like what is the Fed doing, what is the outlook and all that. It doesn't really matter that much. And so I said it's very, very like figuratively, people will say, hey, mean easy for you to say, but you really think about it, like all this like really in this outside of control one, how does it, let's say using Tesla example, how does it affect Tesla business? Eventually, right, what drives the Tesla stock price in the long run is the company fundamentals, right? So there's this example. Now let me see if I can articulate it well. So for example, some of you might have pets, and then you bring your dog down for a walk, right? And then it's on a leash, right? Where the dog can go, like, from where you are, you can go forward, you can go sideways, you can go left, you can go right, you can go behind you, right? But it will always be within that leash, right? So the dog in this case will be the stop price. Right? Where the stop price can go, sometimes it can go 20% higher than its real valuation. Sometimes it can go 20% lower, but it will be within a certain kind of within that leash, right? Of a certain distance, right? It cannot go far out too much, right? And eventually, if the business do well, so let's say I'm in the human being and I keep walking forward, the dog that is on the leash, although he's like trying to go back, I will pull him along. The stock price will have to catch up eventually. Okay, might not be the best example, but I hope you guys get it. Okay, yeah. So this is the thing. Always focus on the business, because using the dog leash as an example, right? The dog will have to, if the leash is pulling the dog forward, the dog just have to move forward, right? So focus on the business per se. Right? What you can control is your own emotions, right? So emotions, some people might look at it a bit more underrated. They always focus on technicals. But if you have the best technicals, you know what company to buy, but you didn't buy them at the right time, because during the COVID crash, you were listening to the noises. This time is different. Maybe the pandemic will be a bit longer. All right, like, you know what I mean? Like, literally, you get sidetracked, but by all the external noises. Jeff Young is asking, so I realize some of this question, some of you might be a bit new to. How many of you, this is the first time you hear me speak or not? Like, this is the first time, just curious. Also, if it's the first time, please type 1. If you're not new, right, type 2. I just want to get a sensing of, like, who am I speaking to? So I think just now Jeff is asking about how to prepare for a market crash, right? You can always keep a certain percentage of your portfolio in cash. Like, so in portfolio management, right, I do cover a good setup will be, maybe you can be invested 70% and then you hold 30% cash. If you are more kiasu and are more new, right, based on your experience level, then don't need to go 70-30, you can go 60-40 or 50-50. All right, but I would say the most bulk of your portfolio is invested in company, because in the long run, right, it doesn't matter if the stock market is going to crash or not. Like, you just ride it through, right? So in the long run, it doesn't really matter. But at the same time, I do understand, like myself also, sometimes I like to take advantage of cheaper prices to buy more. So as we hit last year, right, towards the pandemic, I was holding quite a bit of cash, and then as we drop, I just let in, right, and to buy the cheaper prices. Can you imagine buying Tesla at $100? Yeah, so this is the some of the good opportunities, but to be prepared. So opportunities will come, right? They will eventually come sooner or later. But the thing is, come ready. Are you ready for it? Like, are you prepared to capitalize on it? Right. I also shared my views on crypto, my allocation to crypto. Right. You can check out my crypto portfolio. I upload it on YouTube also. All right. So it's been almost an hour. I hope you guys like this sharing. I will keep it short. And those of you who missed the earlier half, I will upload this video up soon. All right. Hopefully by this weekend. All right. If you guys find the sharing useful, right, let me know in the comments, right? And maybe just type, what's your one takeaway, and what is your one insight or one actionable step that you might take out of this, like, from the last 1 hour. Is there anything you'll be doing moving forward, or you just hearing hear song, but you won't be doing anything, right? So let me know in the comments below. Okay, some of you saying you want to hear more on ETFs, right? Okay, so I will give me some time. So actually, I didn't want to spend too much time on ETFs and like this. In my opinion, is very, very boring companies. But I do understand boring companies are always good. So I want to focus more here, but I also want to touch on this to get it out of the way also, and to give a bit of context for you guys. So maybe maybe I will do a video on ETFs, maybe next week, and I will do one on, I would say, stable to grow companies. So around maybe around here, right? So after all, this is where I started personally also. Some of you might know my favorite, my first love when it comes to investing is actually Visa, right? So that was my long-term first love, right? But some of you, I also shared why I ditched my first love for another company, okay? All right, thank you guys so much. All right, see you guys. Have a good evening and a great weekend ahead. All right, bye-bye.